Hello, everyone, and welcome to Fundamental Auditing, Chapter 3. So Chapter 3 is on auditors' ethical and legal responsibilities. So ethics, basically, is a branch of philosophy which, in the systematic study of reflective choice, of the standards of what's right and what's wrong. Accountants or auditors have to use professional judgment in auditing. So to determine if management is doing something ethical or not ethical, and make sure that the auditor are behaving ethically as well. So professional judgment, you're using your critical thinking on the accounting issues, you're using your knowledge and technical training in order to determine, using your professional judgment, if something looks right or something looks wrong. You're also using professional skepticism during the audit. We've talked about this a little bit in Chapter 1, but basically professional skepticism is having this inclination to question everything that management tells you. So whether that's oral, so you've interviewed management and they tell you something, written, or like contained in the accounting records. Accounting records are a certain way. So, a journal entry is done a certain way and management explains how it's done or why it's done a certain way. You're always kind of questioning that, and you want to get the evidence, not just rely on what management says. So you always have to kind of be skeptical about what management is saying and make sure you're getting the sufficient evidence to support what management is saying. There are codes of professional ethics in the CAS standards. Auditors have to have these 5 fundamental principles. The first one is professional behavior. So they need to maintain a good reputation as auditors of the profession and as CPAs, because they are serving the public interest. So even though they get hired by the auditee, they're still kind of serving the public because they're serving the users of the financial statements. Auditors have to have integrity and due care. So when they're performing professional services, they have to have integrity and they have to have due care where they are following the principles. They need to have professional competence. So we talked about this a little bit in Chapter 2. So they need to have proper skills and training, and it's important for them to maintain their competence over time by doing continuing professional education and experience. So if you're an auditor or if you're a CPA, you have to continue doing professional development in order to maintain your CPA. So it's not just you learn something and take a course and that's it. You have to continuously take courses or go to conferences in order to maintain your competence. The auditor also needs to have some confidentiality of client information, so they can't see some client information and go off to their friends and tell them all about the client and how much they're actually making and what type of errors they found. And they need to have objectivity. So their judgments must not be impaired or perceived to be impaired. They need to be independent. So they shouldn't have any biases or anything towards the people or the financial statements that they are auditing. So we'll look at this a little bit in more detail. So integrity is the duty to be honest and conscientious when performing professional services. So you have to be honest when you're performing your services. You're not doing anything like sneaky or anything like that. Objectivity is to hold yourself free of any influence, interest, or a relationship that would impair your professional judgment. And then independence is basically being objective in an assurance engagement. So in an audit, you're being objective. So I want to dig into, hold on. Just one other thing I want to say about confidentiality before we move on. You have to have confidentiality, but it's not the same type of confidentiality that like a lawyer and a client would have. So there's the lawyer-client confidentiality, but for auditors, you may be required to provide information to the courts. So if your client is getting sued for some reason and they call upon you, the judge calls upon you, you do have to provide that information. So it's not like lawyer and client, where if a lawyer tells a client that they've committed a murder, that lawyer is not going to go and tell the judge that. But for the auditor's point of view, the auditor does have to provide information necessary to the legal authorities if they are asked for it. Okay, so it's a little bit different. So you can't go off and tell other people about the client, but you might be summoned to the courts and have to provide the information necessary. All right, so let's dig into independence a little bit more. When we're talking about independence, there's 5 threats to independence. So everybody in the audit team, so when you're doing an audit, when you first decide that you're going to take on this audit client, you have to determine who is your team of auditors that are going to be auditing this client. So everybody in the team needs to be independent from the company that you're auditing. And there's 5 threats to independence. And part of your documentation when you're doing your audit, you have to, like in your planning phase, you have to make sure that there are no independent issues and disclose anything that could be perceived as independence issues. If it's clear that you have an independent issue, you cannot accept the audit client, right? Or if there's one of the staff members that does have an independence issue, then they would not be put on that audit and somebody else would. So the 5 threats to independence are a self-review threat. So self-review threat is you're providing assurance on your own work. So if you, like, let's say that you're the bookkeeper or the controller that's creating the financial statements, you can't then be the auditor because you're going to be reviewing your own work. Okay, so you can't be reviewing work that you've done. So kind of like a popular example is that sometimes clients ask their auditors, oh, what should my accounting policy for this be? How should I record this? If I have a complex transaction, can you help me figure out how to record it? So they can't really be offering advice like that and telling them how to record something and how to do something on their financial statements, because then they're basically reviewing their own work. If they did a portion or helped do the journal entries or something, then they're basically reviewing their own work. Okay, so they can't. That's not being independent. The second independence threat is a self-interest threat. So benefiting from a financial interest in a client. So, owning a large number of shares in the company that you're auditing. So if you have some sort of financial interest in the client and you're, getting paid dividends, or you want the share price to go up so you can sell your shares, then you probably are going to be biased in making an unmodified opinion where you say the financial statements are free of material misstatements, right? So like you're inclined or motivated or biased towards having a clean audit opinion without any issues in there. Okay, so you can't really have some sort of financial interest in your client because that would be a self-interest threat and you wouldn't be able to do the audit. There's also advocacy threat, promoting a client's position or opinion. So maybe you're like, if you're helping with the sale of the company and you're getting some money out of selling the company, then you shouldn't be auditing that company as well. Okay, so just promoting the client's position or opinion, you can't be doing that. There could be the familiarity threat, so becoming too sympathetic to a client's interest. There's a couple examples of this. Here you could have like a family member that works at the company. So if you're auditing like a company that your mother works at, so you probably would be biased or inclined to provide an unmodified opinion, saying that the financial statements are free of material misstatements. Another example here is it doesn't even have to be family members. It could be something like being really good friends with your audit client. So if you're such good friends with your audit client, you probably would be geared towards providing a good, clean, unmodified opinion rather than saying that there's issues in the financial statements. And then the last one is intimidation threat. So this is being deterred from acting objectively by some sort of perceived or actual threat from the client. So the client says, you better give me an unmodified opinion, saying that the financial statements are free of any material misstatements, or I'm going to fire you. And maybe this is like a huge client for the auditor, so they don't want to be fired from that job. Okay, so that could be the intimidation threat. So if you have any of these threats to independence, then you probably cannot do the audit of the financial statements. You would have to decline the client. Okay, so this is something that in the pre-planning phase, before accepting the audit client, you need to make sure that you as an auditor and all your staff don't have independence issues. Something like having a bank account at a company, like, so for example, if you're auditing TD, so you're auditing TD Bank, having a bank account with TD Bank probably won't kind of make you not be allowed to do the audit, because it's like, how much are you going to be influenced to say that they have the company's financial statements are free of material misstatements, because that's not going to really like affect you or your bank account. So you still have to, any type of independence threats, so something like having a bank account at TD and then auditing TD has to be disclosed. So you definitely have to disclose that, but something small like that, you probably could get away with not stepping away from the audit. You could still probably audit, because it's not really effect on you. You're still going to have that that bank account, even if you give an unmodified opinion or a modified opinion. Okay, but it does need to be disclosed. So I think I talked about most of these examples. So having like direct financial interest in the client, having like loans, maybe you loaned money to the client, or the client has loaned money to you. So that would be an independence threat. Having an honorary position in a non-for-profit organization. So having some sort of position in a non-for-profit organization and then auditing them, or even being like a board of director of a non-for-profit and then auditing that, so that's not allowed. Retired partners, if you were, so this could go like an example of this could be that you retired from a company and now you're auditing that company. So like you switched jobs. So you were, the controller of a company and now you're an auditor of that company. Other things, providing accounting and other services. So if you're providing bookkeeping services or accounting services, then you can't audit the company. And that's a self-review threat. There is a rule around having a rotation of partners every 5 years. So if you're a big accounting firm like PwC or Ernst & Young, KPMG, you need to rotate your partners every 5 years. So if you're doing an audit, so if the partner is doing an audit, after 5 years of doing the audit of the same company, you have to give away that client to another partner of the firm, because then there is a familiarity threat. If you're doing the audit every year, you could develop a good relationship with the client, maybe become friends, stuff like that. So that's a familiarity threat. So every 5 years, there has to be a different partner doing the audit. And there also is a second partner reviewing the work, just in case there are any biases. A second independent partner would come and review the work. Having any like actual litigation, investing, any family relationships. So we talked about those. So other auditor responsibilities. So auditors take the responsibility for detecting material misstatements. An expectation gap exists when what the users expect and what the auditors are able to accept. So the auditor isn't hired specifically to detect any like fraud and theft and illegal acts. They're just checking to make sure that the financial statements are not materially misstated, but they're not there to determine whether something illegal is happening. If if they find out through their work that something illegal is happening, then they do have to for sure talk to the authorities about it. But that's not their job. Their job is not to go in there and look for something illegal and look for theft and look specifically for fraud. They have a responsibility to check to see if during their work there is some sort of fraud by going in and detecting any material misstatements. But sometimes users think that they're going to go in and make sure nothing illegal is happening, make sure there's absolutely no fraud, absolutely no theft. But the auditor is only looking at things that are material. So if there's theft of like a little bit of money here and there, that results to like a big number at the end. But if it's just a little bit here, a little bit here, a little bit here, the auditor's not going to find that because they're auditing the big numbers, not the small ones. So the auditor needs to have a duty of care to their client and to the financial stakeholders, the users of the financial statements. The auditor needs to, before accepting the audit client, make sure they know what type of clients are being accepted, like make sure you have a thorough understanding of the client's business. If you know that there is fraud going on or theft or they have a lot of legal issues, then you might decide not to accept the audit client because you don't want to have any problems or be associated with a company like that. So the auditor has, needs to do its homework before it decides to accept an audit client, and not accept an audit client that is shady or doing illegal things or something like that. There has been a lot of litigation in the past. So if there is companies that are doing fraud with their financials, so if they're reporting improper numbers or inflating their revenues or something like that, there has been instances where auditors have been under scrutiny too and been fined, or there was this one case where an audit firm had to stop auditing and close their business because they did not find these fraud related activities, and it was, I guess, determined that they should have found it during their audit work. So because of all that, this has increased improvements in the audit working paper files of the auditor. So the auditor has to document everything that they do. So they're going to have working paper files where they, and we'll talk about this more in the later chapters, but basically their files have to show all the documentation of all the work they did, everybody that they talk to, what do they do to learn about the client's business. Everything needs to be documented. Okay, so detailed memos, documenting discussions talking about audit fees, having management letters, which we will talk about later on, but management letters is basically a letter where management says, these are my responsibilities. The auditor has their responsibilities, so everything's kind of clear. All right, so that's the end of chapter 3. So thank you for listening and take care.